Well, after all of that, let's bring in a corporate voice at the top of 10 now. Mr. Gopal Balachandran, CFO at ICICI Lombard, here to speak with our stock. Obviously, a buzz. To start with, sir, could you share your outlook for FY26? Specifically, how should we interpret your expectations versus what has already happened in H1 in terms of growth as well as in terms of the trajectory on the combined? How are you seeing it?
From an ICICI Lombard standpoint, our philosophy of underwriting has always been to kind of stay focused on driving profitable growth as a theme. And to that extent is what we have tried to kind of balance growth with prudent risk selection in terms of how we have kind of gone about underwriting the portfolio. To your specific point on how do we see the trajectory play out in terms of the second half of the year, I think the thought process is pretty much the same, as in to kind of keep sustaining profitable risk selection opportunities. And in the process, try and see if we can kind of continue to see an improvement in our combined ratios relative to what is getting exhibited currently. And on a sustained basis, I think this is something that we have spoken even to the markets and also to the investors and analysts at large, to try and sustain a return on equity in the range of 18 to 20%. So that is something that we will be kind of very, very actively working towards. But all in all, I think obviously we would want what we are seeing on ground is a very, very positive momentum in terms of our ability to write incremental growth opportunities. And hence to that extent, particularly in the context of second half, I think very, very excited to see how that is likely to play out for growth in the context of ICICI Lombard.
Right. And your gross premium, that declined about 12% sequentially. If you can just share your thoughts on that.
I think quarter on quarter will always be there will be always various nuances when you start looking at numbers more on, let's say, sequential quarters, because quarter one of any financial year will be significantly heavy on the corporate/commercial lines book, because most of the corporates typically tend to kind of renew their portfolio in the quarter one of the year. Whereas typically you will see quarter two, quarter three are periods where relatively the proportion of the retail lines of businesses are slightly more higher. And also you get to see to whatever extent that we participate in the context of crop insurance, you will also get to see some of those bookings happening. But a better way to kind of look at it will be more, let's say, either a relative quarter of the same period, let's say quarter two of this year to quarter two of last year. So hence, in that context, I think our growth would have been relatively, in that sense, subdued, because equally, quarter two of last year, we did have a slightly higher amount of crop insurance premiums that had got booked. However, relative to that, I think if you would have seen in quarter two of this year, I think the proportion of crop insurance has been relatively lower. So that's one of the factors when you see the growth numbers. But more than that, I think what we are very excited with is the mix of business that we have been able to underwrite from a profitable growth standpoint. I think that is something that we are very, very excited with. And that's the reason if you look at from in terms of outcomes, there has been an improvement in the combined ratios, whether you look at quarter two of last year to quarter two of this year on an end basis. And that has also translated into what I talked about in terms of return on equity of slightly more than 20% that we have been able to exhibit.
And Mr. Balachandran, with regard to underwriting losses, they remain elevated. I understand that there were some cat losses which came through this quarter. But what's being done? Is there paths to improvement with regard to that as well as profitability?
I think again, this point keeps coming up many times. And we would want to kind of keep reiterating the fact that when you look at an insurance company's financials, the way the accounting prescription works currently is when you write a risk today, the earnings of that risk will happen through the policy period. However, any cost that we would have incurred with respect to sourcing that particular policy gets expensed out immediately. And that is the reason when you get to see from an absolute underwriting outcome, you may possibly see an outcome which is in that sense maybe a negative or maybe an adverse number on an absolute basis. That's the reason why we keep saying a better yardstick to look at an insurance company's financials is more on the combined ratio of what gets exhibited. And that is what I was kind of referring to. So for example, if you would have looked at the Q2 combined ratios on an N basis last year, that number for the company as a whole was 104.5%. And the same for Q2 of this year, that number actually kind of looks better at about 103.9%, again on an N basis. So we have actually been able to see an improvement relative to, let's say, the quality of risk that we have been able to underwrite. Right? And therefore, from an absolute basis, I think it is because of the way the accounting prescription works, it may not truly reflect the outcome of the book that is being underwritten. Combined ratio / return on equities are better matrices to kind of look at in the context of the outcomes for a general insurance company's financials.
Right. And what led to the degrowth in group health? And do you expect a recovery in the second half of the fiscal?
Yeah, so I think group health is definitely one of the segments that remains an area of focus, because that is something that we are able to exhibit. Along with group health, we are also exhibit a lot more lines of businesses when we kind of deal with corporates, whether you look at fire, whether you look at engineering, marine cargo, liability, etc., etc. And within that also, we are kind of quite positive for the group health line of business. Um, uh, the way we have kind of looked at from an ICICI Lombard standpoint on corporate health has been, it has obviously been an opportunistic play. I think when we see the pricing levels right, I think we are able to kind of write incremental businesses. That is also what got reflected. If you would have seen for the month of September, again, I think we have been able to kind of exhibit a positive growth. But where we see, let's say, pricing pressures getting exhibited on that segment, and therefore to that extent, then we will start taking relatively a guarded stance. So hence more an opportunistic play, depending on what kind of pricing environment that we get to see in the market. But the way we have looked at corporate health is not just to look at it on a standalone basis, but obviously look at how we can kind of work with the corporate in trying and make sure that we are pretty much a part of the insurance offerings of the corporate across different risks that we propose to cover for them.
And how is the shift towards motor likely to happen? Is it going to impact your portfolio, profitability, claims ratios? What's the outlook on motor is what I'd want to really understand, because there's such a push with regard to auto growth.
In the recent months, we do see incremental opportunities playing out also in the context of commercial vehicles. And therefore, to that extent, possibly you may see a mix which can undergo a change. So that's something that we keep balancing every month in terms of which are the segments that we need to underwrite, which are the segments that we need to be slightly more guarded. And therefore, the outcome is what we kind of exhibit to the market. To your final point on how do we see the trend play out for motor going ahead, this has to be looked at in a couple of contexts. One, if you look at for motor industry combined ratios for motor is at 125%. And therefore, to that extent, it effectively means that you're losing 25 paise for every rupee of premium that you're underwriting. So that's a lot of money for the market to lose that. And therefore, to that extent, you have to be slightly more guarded in terms of what kind of quality of risk that you want to underwrite, which is why we have been very, very selective on the quality of the book that one wants to write in the context of motor. But within that, I think we are seeing a lot of green shoots, particularly with the spate of reforms that the various regulatory authorities have been able to put on ground. And that is kind of auguring very well in the context of ICICI Lombard. But in terms of how does one see the growth play out, very, very positive is the way we kind of look at in terms of how things will play out. So that is one factor in terms of the combined ratios for the industry. The second factor is this is the third year of the glide path for expense of management guidelines. So companies which have been in exceedance of the limits on expense of management has to bring down their expenses of management. For ICICI Lombard, we have always been well within the limits, and therefore that will also be a key factor that one would look at very, very closely in terms of how growth in motor is likely to shape up for going ahead.
Right. And has the GST reform triggered any early signs of product innovation or cross-sell opportunities, particularly in the health and motor segments?
What we are very, very excited with is the various reforms that has been exhibited on ground by various authorities, whether it's the government or whether it is the our own regulatory authorities, or even for the matter of fact any other regulators. I think generally what they have kind of been able to put across is a spate of reforms which augurs very well in the context of customers' momentum getting played out. And that is what is getting exhibited. If you look at the early signs in terms of pent-up demand / festive cheer, that is getting exhibited in the context of higher volume sales of vehicles that one has been able to see, and that is something that we called out even as a part of the investor call that we had last evening. And even in the context of what they have done on health, in terms of removing GST on health insurance, retail health insurance premiums, that again kind of augurs very well. And this is one area where ICICI Lombard has any which ways been investing in terms of expanding distribution and improving our product suite. And very happy to note that from an ICICI Lombard standpoint, consequent to some of the measures that we have been taking and with the spate of reforms that has been put in the context of GST, our retail health market share, as we speak, for the month of September has actually kind of crossed more than 4%. Just to put this in context, our retail health market share used to be averaging anywhere between 2.9-3% thereabout for quite some time. And with the changes that we have been able to exhibit and including the reforms that one has been able to see that, I think clearly, I think we are again very, very excited with how things are playing out. And with this reforms further, it is only going to add more impetus in the way we will be able to kind of write this particular line of business. So very excited with the opportunities in terms of the road ahead.
Right, great to get in that color from you on the earnings gone by and of course the future visibility as well. Good speaking with you. That's the management of ICICI Lombard. On that note, we're going to take a very quick break.